Well, it's January 23rd, the market update desk and Mortgage One with Scott Riley. Well, we started our day out with some rain slash freezing rain for weather. It was a little bit of an interesting drive in. A lot of the schools here are closed for the day. So there's a lot of kiddos and teachers that are loving that. So a little bit of a calmer day today in the market as we get closer to the end of the week with the focus on personal consumption expenditure report that comes out on Friday. Stocks and bonds mixed today to start. There will be several auctions, though, this week, starting with a $60 billion auction of two-year treasuries later today. Over the next few days, between the 2-year, 5-year, and 7-year auctions, there will be a massive 162 billion auctioned of treasuries. This is a lot of paper that needs to be absorbed by the bond market. Now, whether we see the same level of interest from institutional investors, foreign investors, is going to tell us a lot of how strong the bond market's going to be and what impact we're going to have on pricing. So it's a huge amount of bonds that are going to get auctioned off, and that will have a lot of sway over, like I said, pricing between now and early Friday. Another item that came out today, LEI Index, or Leading Economic Indicators, which is a forward-looking index that takes a broad look at the economy and often is a reliable recession indicator. Now, for December, for example, LEI fell 0.1%, which was the 21st month in a row of negative readings for LEI, which it's a big deal. Without the increase in the stock market that we saw the last 6 weeks, ending 2023, the index actually would have fallen 0.3%. The index is clearly still showing a signal for recession, despite most that are thinking we'll achieve this soft landing or Goldilocks or avoid one. So there's still significant concerns on recession. The conference board said that they believe we'll see a short recession beginning Q2. Overall, they expect GDP growth to turn negative in Q2 and Q3 of 24, but begin the recovery late in the year. Now, what's interesting is by the time we get into a quote recession from the government governing board, it's actually about a quarter or two after we're actually in the recession. So when the government finally calls it that we're in a recession, we've already been there, and it's a little bit late to call it. As we've been talking about, the Q1 and Q2 of 2024 is likely going to be less than initially expected, and we'll probably see a revision to Q4 of 2023, showing that it's not as rosy as what a lot of the indicators or reports have been. Now, on a technical analysis, mortgage bonds have been trading sideways and are still in a wide range of resistance at the 25-day moving average and a support at the 50-day moving average. They've formed a base around 101, which has been at a level the mortgage-backed securities have dipped beneath, but managed to close over the last couple of weeks. 10-year treasury is trading at about 4.13, just beneath an important resistance at the 50-day moving average of 4.15. And this is a very tough customer that luckily has given us some guardrails to go above. Now, as we move in through these bond auctions and get to Friday, these resistance levels are going to be very important to try to keep so that we can get the full benefit of what's projected to be a positive inflation reading through PCE on Friday. Let's hope we can get through these days. We'll keep you updated with any major developments. Like I said, always give us a call. We'll help you get pre-approved. It's just really critical for buyers to understand. Don't wait for the spring, because that's when it's already going to be too late. Don't look in the rearview mirror. Be out in front of the pack and out in front of the wave. Give us a call, 616-293-2189. We hope this finds you well, and have a great afternoon.